it in some kind of global perspective, figure out how global markets are going to impact us here in Dubai. And to do that, we welcome a friend of mine, someone I've known for an awful long time, and someone whose insights on the global and the regional economy and how those two intertwine are, I would argue, second to none here in this town. And interestingly, she's also a specialist on fixed income markets. And if ever there was an industry that relied on fixed income financing of some form or another, then the real estate market is it. So, to talk to us about the New World Order, its perspective, and its impact on the global economy, please join me in welcoming the head of fixed income research at Emirates NBD, Anita Yadav. There you go, Anita.
Thank you.
I'll pass the baton.
Thank you. Good morning, ladies and gentlemen. Thank you for being here and giving me an opportunity to share our view on global events. My name is Anita. Thank you, Richard, for the introduction. So Dubai is in the top 10 global cities, has a huge expat population that invests and lives and enjoys life here, and has a government that promotes international investment here. Yeah? So obviously, there is quite a bit of international interest and investment. So the events happening around the world have impact on what real estate developers, investors, analysts like me, and mums and dad investments in the sector get affected. In next 15 minutes, I just quickly want to touch upon the key economies around the world, what's happening there, and then you know, happy to take some questions if you wish to draw it down to the impact here. The things that I want to say, before even I get into the individual economies, is basically the key three things in the wider world. One, since the global financial crisis, this is first time in this decade where economic growth, economic development around the world is synchronized, which means the developed world is growing, the emerging market is growing. In the developed world, there was a time, particularly say in likes of Eurozone, where you had the stronger economies were growing, but the peripheries like Greece and Italy were struggling. But now, I guess, again, very optimistically in the last decade, right now, even the peripheries are growing. So economically, there are very few skeletons in the cupboard right now. Even the risks about the China, shadow banking and asset bubbles in China, those seem to have been abated. The central banks there seem to be in control of the situation. So economically, there aren't very many scary situations. But having said that, I think the bigger impact, there are a lot of intelligent, talented people in the world, forward-looking. Unfortunately, not many of them are in developed world politics. So the issue right now that the world is facing is basically the geopolitics and its impact, whatever is happening in the US White House, whatever happens on the North Korea space, the things that are happening in Eurozone. So geopolitics is probably the key risks looking ahead in the next 12 months, in our opinion. A little bit comfort that I get is from the fact that, yes, there are risks, but financial markets, the interest rate world, the fixed income, which is what affects your investment in real estate, is probably a little bit resilient to material shocks. Say, for example, in the White House, I think the ability of some key people to influence dramatic impact and have negative impacts is controlled by the Senate. The things in Europe are also a little bit, the markets seem to be able to control those. So that's a little bit comforting, of course. So these key issues are very hard to predict and very hard to make any kind of forecast based on these. I will move on to economic landscape. US. Why US? US is not necessarily a big investor in the regional investment space, But the pegged currencies means whatever happened to the US economy will translate into what happens to the US rates, which then translates into what happens to the interest rates in this part of the world, and obviously what happens to the financing for the real estate. So where is US? Unemployment level in the US right now is at 2-decade low, 4.3%. It's actually lower than what you call is sustainable near unemployment. So it's a very good picture. Economic growth, solidly in 2 to 3% range per annum. Now, for us sitting here, when you see 6% plus growth in India, 6% plus in China, yes, a 2.5% growth doesn't look very impressive. Having said that, for the developed world, for a leveraged kind of economy like the US, a 2 to 3% growth is actually very respectable. Think of it in terms of Japan, which hasn't seen more than 1% inflation or more than 1.5% growth since 1991. For 30 years, it has been stuck in that range, the developed world. So in that regard, then a 2.5% growth in the US is seen as very, very solid. I think the only issue that sometimes central bank, not sometimes, that the central bank is looking at or will be concerned about is inflation. Inflation around the world is low. In fact, as my first slide was showing, nearly 35% of the population lives where investment is where interest rates are less than 1%, or some of them are even in a negative territory. So if inflation remains low, it's kind of a Goldilocks scenario for the real estate industry, because low inflation means low interest rate means low cost of funding. So in the US, I think the economy as such is reasonably strong. We are quite comfortable with the fact that regardless of what happens in the Senate and the White House, the economy is likely to remain strong. Yes, it has seen 8-9 years of consistent growth, but a recession or a downturn is not expected in the next 12 to 18 months. Europe, a lot of tourists, a lot of investment in the regional real estate comes from Europe and UK. In UK, there was a bit of a fear that Brexit would lead to contraction of the economy, recession could set in. Those fears have been found to be overblown. The economy has coped really well. Again, unemployment in UK is at 4-decade low. Inflation is 2.5%. Brexit is, the conversations are going on. It goes up and down. Yes, there are days of negative news, but overall it seems like both sides, Eurozone as well as UK, Brexit negotiators are reasonably keen to cooperate with each other. It will probably not be as catastrophic an event as was predicted when it happened. So UK seems to be doing okay. The currency, which affects the level of tourism and investment that comes into this part of the world, UK currency is holding up reasonably well at 130. We think it will probably fluctuate between 125 to 135, which means tourism into this part of the world and investment into this part of the world that come from UK will probably remain stable. Eurozone, as I was mentioning, after a very long time, it's a synchronized growth across the peripheries as well as the central one. Growth at 1.5%, inflation at about 1.3% is the best that we have seen post the financial crisis. So again, we expect stability there and continued flow from that part of the world. Oil. The thing about oil is, one of my favorite sentences, Stone Age didn't finish because stones finished. Oil era will not finish because oil finishes. I think oil era world will probably move to different energy sources, and our reliance on this source of energy is probably likely to slow or remain lower than the supply side. And that basically translates into time or a decade of low oil prices, or at least oil prices in the double-digit range rather than triple-digit or 140, 150 that we saw a few years ago. In that case, it's very heartening to see that the GCC economies are now attaching a lot of urgency in removing its reliance away from hydrocarbons. The fact that this room is full of people from all walks of life and how much emphasis is being put on technology like blockchain or real estate development, it's all a sign of how we are moving away from oil, reliance on oil. Having said that, the government budgets around the world are still funded by 85 to 90% by sale of oil and money coming from there. There are no taxes being collected, and the other source of revenue is reasonably limited, Dubai being an exception. But now the VAT, the indirect taxes, the diversification of economy, it's all the positive signs. So over the next 2 years, we expect oil price to be 51 to 55 per barrel. What it means for banking sector, because in the end, that's what affects the investment and the financing options for real estate, is probably liquidity will be sufficient to fund a lot of large projects. And the world here has become a little bit more open to raising money, not just from the banks, but from the capital markets via bonds and loans and tapping into the international money. So funding, I think, will probably continue at a pace that is supportive of real estate investments. GCC outlook. So there was a slide that I saw which was talking about Dubai real estate investment, where it comes from. So the real estate investment in Dubai, as you can see, it's basically UAE investors and residents contribute about 25%. India 13, Saudi 8%, UK 5.9, and then there is a lot of GCC investors that will make into the 32% of the rest, including some Oman, Bahrain. Saudi is obviously one of the big investors, and I guess that's why I'll go back to talking about the UAE economy, what's happening there and what's happening in Saudi. Saudi government used to spend about 1.1 trillion riyal per annum on its budget. As you probably have heard, there are some cut downs on the government budget. They are trying to balance their budget and reduce the deficits. It's down to roughly 850 billion riyal right now. That's a cut down of 200 to 250,000, and that obviously is slowing the economy. So we've reduced our forecast for this year for Saudi economy to be at about 0.5%. Having said that, if we drill down deeper into what the government has reduced in terms of spending, I think a lot of it is the wages and the salaries and some of the projects which had not taken off the ground, some cutback on oil constructions and things like that. But the investment into the likes of educations and schools and the hospitals and basically affordable housing, those kind of projects are still kept well and alive and continuing. So yes, everything seems to have slowed in Saudi, but overall, looks like this is probably the bottom. And next year onwards, when some more revenue from VAT comes in, some more revenue from oil prices, if they remain above 51, 55 comes in, some other measures help, the government will probably increase its spending and economy will pick up. UAE, by the way, a lot of our downward revisions of the growth in the region are basically because of OPEC-led cuts in oil productions. So previously we had assumed that the cuts would continue at the levels that OPEC had agreed in November, but I guess they extended it to March next year, and that's why some of the growth has been revised downwards. Again, UAE is better placed than Saudi. Our economic forecast is 2% this year, growing to 3.5% next year. Mind you, a lot of that slowing is coming more from oil-related stuff in Abu Dhabi. Qatar is not a big investor in the real estate space here, politically charged situation. but they do have a whole lot of their own investment going on in FIFA World Cup-related infrastructure investment there. We do see a little bit of downside in Qatar as well, much in line with what's happening in GCC. The difference in Qatar versus rest of the GCC is Qatar has a lot of revenue coming from gas. So it's not as much reliant on oil, but it's more coming from gas. Although the prices of the gas do move in tandem with oil, but it's a slightly different dynamic. Egypt, I'll skip. Indians tend to be big investors. Indian diaspora make a big chunk of the expats here. What's happening in Indian economy, it has slowed a little bit, as you would expect, when shocks like GST or the demonetization that we saw last year happened. But it's an economy that has 1/5 of the world population living there. Just the consumer-led growth is sufficient to continue high single-digit kind of growth in India. Now, Indian investment here, 2 years ago and even last year, suffered a little bit because the Indian rupee had weakened against the dollar and dirham. Another thing was demonetization suddenly took a lot of people by surprise, and the flow of money that was coming from unaccountable sources obviously had to be arrested back. So since then, the rupee to dirham seems to have stabilized a little bit. The impact of the demonetization has moderated, and we think that investment will begin to flow again. Now, as Richard was mentioning, interest rate is the key thing that affects. This is just a 30-year snapshot of what happens to real estate versus interest rates. This is US. It's a developed market because the data collection can date back to 30 years. Here, we don't have that longer dated data, but the overall relationship of interest rates impact on real estate is the equation, the fundamentals are roughly the same everywhere. Yeah? So it tells you clearly, and as you all would know anecdotally, when the rates are low, your ability to borrow is higher, your ability to invest is higher, and obviously that helps the real estate prices. Yeah? This is just a quick snapshot of what's happening to lending in UAE. This is the central bank data. As you can see, the lending in terms of the dollar growth in absolute numbers is still growing. But in 2017, as a percentage growth seems to have slowed. Not surprising. It's partly because the new Basel III laws that are coming in picture, banks are becoming a little bit cautious in how much exposure they take to individual each sector. And based on that, they have to rearrange a little bit of their credit policies to see which sector they lend to, and they're becoming a little bit cautious. It's not to say that the lending has stopped, plus the fact that a lot of real estate developers now may have access to capital markets. So we've seen likes of Mira's Holding, which actually, instead of going to the bank market, went and raised 600 million via Sukuk, 400 million in May, and then 200 million recently. Right? So they don't necessarily have to go to the banks to raise money for their developments. Or DAMAC can come to the capital market and raise money there. Or Emaar. So this data, even if it shows that lending to the construction and real estate sector has moderated, is not necessarily conclusive in assuming that funding is limited. It's just to say that the alternate sources of funding are being used by the developers and the real estate investors here. So this picture is not all conclusive. Just a quick snapshot of where Dubai real estate prices are, particularly the housing one, versus the 3 or 4 top economies in the world. As you can see, US housing price graph is an up, and that's reflective of the fact that it had fallen 40% in 2008, so it's starting from a low base, and reflective of the fact that interest rates have been really, really low in the US. The Dubai apartment prices, as you can see, appears reasonably speculative. But the silver lining that I find in that thing is, The more speculative and risky a particular market is, the higher is the yield. You invest in UK or Euro, you'll probably get a 2 or 3 or 4% at best kind of yield. You select nicely and with proper due diligence, you can very easily get 6, 7, 8% kind of return in Dubai real estate. So yes, it is partly because there are a lot of expats or international money that is basically speculatively invested here. Previously, at least, it was more speculative. Now there is a lot more control through RERA and DLD laws and mortgage laws in the bank. So hopefully this kind of volatility will reduce going forward. But I guess you can make volatility your friend, and it can help you in your higher yields. This is just in dollars. This chart we have talked about. This is just a quick snapshot of what's happening here. Yeah? Happy to take questions.
Anita. Who's got the first question for Anita? Yes, please, the gentleman right at the front here. Do we have a microphone for this gentleman? Just on the second row, right in front of me here. If you could raise your hand again, please, sir. My colleague, Imam, will give you a microphone. Thank you.
Thank you, Anita, for the presentation. My name is Mohammed Yahya from the Lands Department. I was wondering, it was a very interesting presentation. Don't you think, or do you see that due to the high return on investment, it's currently a buyer's market rather than a rental market, where in the UK, as you mentioned, the returns are around 2 or 3%. It's currently very tempting for the people who rent, or let's say the tenants, to buy rather than rent. So wouldn't you say it's a buyer's market more than a rental market? Because once you give the fine line between the 9% return or 5% return, anything below 5%, it's a rentals market.
Okay. I guess it really depends who the buyer is. If the buyer is a 55-year-old person, does he want this kind of risk? I agree with you. If I was young and healthy, I had super confidence in my earning capacity, and I don't mind capital risk, then I would get attracted by a 9% return. I agree with you. But if I was a pension fund from America wanting to buy a block of apartment for my pension fund, or if I was an old person wanting to preserve my capital gain, or if I was borrowing and I need to make sure the value of the house remains at a level where I don't get margin calls from the bank, then I can be concerned about this kind of speculation in the prices. But I do agree with you, for a buyer right now, of renter versus buying, there are pockets in Dubai which will look very attractive. Yes, and it could be considered as buyer's market from that perspective. Yeah. Yeah.
Thanks very much indeed for your question, sir. Time is against us, so we're going to have to leave it there. But Anita, thank you very much indeed for your insights. We really appreciate it. Anita Yadav of Emirates NBD.